Good morning. Mhm.
Good morning, ladies and gentlemen. Please, may we now take our seats. All right. So, good morning, ladies and gentlemen, once again. I'd like to welcome you to our highly anticipated business series. It's on real estate financing. The detailed real estate team would like to just, make you feel at home here today as we chat through the discussions that our panel distinguished panel of speakers have lined up for us today. We also want to make welcome those who are joining us online. Without you, I don't think we'll have a successful event today. So we will invite questions and, give you answers to your questions as we chat through the course of today's event. So for today's event, we have outlined topics that just span across an outlook of the real estate sector, as well as financing real estate investment. So we hope that as we go on, we will gain some knowledge and insight and also have a chance to engage one another through the networking session just towards the end of the event. All right, thank you very much. So at this time, I would like to welcome our lead partner, Mr. Ayuli Jamide, as he sets the tone for the event.
Thank you. Ogale, I think I have some slides if you put them up. In the meantime, I'd just like to welcome every single one of you to this year's place. And to thank you very much for coming. I particularly want to thank Olaomi Alade, our associate partner, and her team for working tirelessly to put this together. Jesu Tony, Ogale, Esther, Labake, and a few others. My role today is just to set the tone, and hopefully I shouldn't take more than 5 minutes doing that. And then after that, the panel session that allow me to moderate. And what I want to do is just to set some context. And what I've put out there is real GDP year on year. From 2015, I was able to get up to 2021 Q1. And I want to highlight two things. We can see GDP had, in this period, some yo-yo. I wish I were in control of these slides. I didn't think that. Can you press? Press the slide. Do you have a clicker? Okay, while we're doing that, you can see two dips on that slide. And the first dip is around end of 2015, 2016. And I'm sure we know what happened. Change of government, investors were circumspect. Okay, what's going on? Let's watch and see who will be appointed ministers, what policies will come on board. While they were being circumspect, the foreign exchange headed south from almost 200, then 300, then it seemed like it was going to 1,000, then it came back. So we had all that happening just there where you see covered, circled in red. And then it bounced back slightly, as you can see. And then there was a major dip again COVID-19 happened. But the good news is after COVID-19, we saw the climb back. So this is the GDP trend, Nigeria's GDP. So let's go to the next slide. So this slide just compares that same GDP trend with real estate and construction contribution to GDP, how real estate and construction were doing in relation to GDP. And one thing you will see clearly is they followed themselves. When GDP was doing well, macroeconomic situation was good, real estate was climbing. When GDP dips, same thing. And you can see the dips in those same places. It's the same graph. We just added real estate and construction. Click on it. Again, those same places. And you can see that, they just, it followed a trend. Next slide. Now this slide just same thing, but now takes it quarterly for a period. And it's interesting to see that even quarterly, real estate is still following the GDP trend. When GDP is doing well, real estate is, even when it comes to looking at it on a quarterly basis. Next slide. This is where real estate is today in its contribution to GDP. It's number 5. 5.31%. This is Q1 2023. A couple of years ago, it was number 7. And I remember some years ago, it was way down below. So I think the real estate market is, is a force to watch and to reckon with going forward. Next slide. So I want to just make some quick predictions by way of setting the tone, and then we'll hand over to Tola. And Tola, I hope I've not stolen your thunder. I haven't said anything that you planned to say, but if that's the case, I think it's good for people to hear it twice. And if you end up saying something that I've said, that means I'm an expert. Because there's no better experts than the bankers. I predict that the economy will reflate. And it's already reflating. A day after the inauguration, the stock exchange market gained 1.5 trillion. I think the current president is pro-business, and that will begin to show in the activities. I think he has a pedigree for surrounding himself with good advisors, irrespective of wherever they come from in the country. And that will begin to yield good results. I think he has the courage to take hard decisions, and we've seen with the subsidy decision, which is where we need to be at this point in time. So what's my prediction? Click on it. I think there will be growth. And if there's growth, I think if we follow the trends of real estate following the GDP trends, I foresee a situation where real estate will be moving from number 5 probably to 4 or 3 in the next 8 years. And, so it's a good time to be having these kinds of conversations as to how we can finance our real estate transactions, how we can be more efficient in our projects, and how we can individually and collectively grow our portfolios and our balance sheet sides, which in turn will contribute to GDP growth. It would contribute to employment and many other indices. So on that note, I'd like to welcome you again to the Detail Real Estate series, and I hope we have insightful conversations. Thank you.
Thank you once again, Mr. Jemede, for that insightful introduction. So just a bit of housekeeping before we proceed any further. So if you look behind you, you would see the convenience. To the right is the ladies and to the left is the gents. So at this point, I would welcome Olaomi Alade to make welcome the next speaker. Just to say a brief word before we welcome the next speaker.
Good morning, everyone. Good. Thank you for making out time to be here. I'm most especially grateful. Thank you to my speakers. Thank you for making out time out of your busy schedules to be here. I'm looking forward to an exciting session later on in a few minutes. Please help me welcome Tola as he takes us through a brief presentation. Thank you.
I think I can do without that. Morning, everyone, and thank you once again for making time, and thank you to Details for inviting me. This is my third time in this room. So the first time in this room, I was a guest, and the second time I was on a panel. I think that was 2020, and 3 years. I think we've been shut down due to COVID, and 3 years afterwards, we are all here. Thank you to Jemede for what he shared, and I think he's done the job. And I was mentioning, you know, are you an economist? Are you an economist or are you a lawyer? So thanks for setting up the pace. And I think what has been shared is profound and speaks to what the reality of the market is. So I think my job is easy in that, you know, I represent Standard Bank. That's the parent company in Nigeria, Stanbic IBTC. And I've currently managed the real estate portfolio, advising clients and extending our balance sheet to unlock real estate opportunities. I see some of our clients here, and we already had a discussion earlier on how we're going to take over and explode the residential market across the country. So Standard Bank, if we can go to the initial slide, the introductory slide. I can speak on, and I'll let you know what slide to speak to. But I think just to provide a bit of context into the overall group for people that might not know, we take real estate quite seriously and are dedicated to it. So we've got teams that are focused on real estate. So from deal structurers like myself to valuers, to the risk analysis team, to the project management team. And we sit across the key nodes of Africa and serving it. So in West Africa is myself and my team. Darren is also here, covering Nigeria, Ghana, Cote d'Ivoire, and hopefully Senegal. And then we've got an East Africa team. I was opportune to be in Nairobi 3 weeks ago for the API conference, and we have a West African outreach of that. That happens in November, but it's always useful having a scope of the market, seeing what's happening elsewhere. Strangely, I mean, of the clients are across Africa, so you can't be limited to just Nigeria. While you're doing stuff in Nigeria, I was speaking to someone, she's in the front, and already stepping foot in Ghana. So why can't we also expand, developers here? Why can't we do projects in Ghana as well, cover the West Africa coast and even elsewhere? And then we've got a team in South Africa covering likes of Zambia, Botswana, Mozambique. So we've been privileged to work with both local players, the likes of Urban Shelter, Landmark, Purple, UPDC, and looking to do much more with as many developers as we can find that share our values and are trying to work across different spaces. I won't speak too much about the offshore clients, but the likes of Actis, Novari that have done credible retail projects, office projects, it's also useful. So I think that's just a bit about what Standard Bank is and what we've done. Ability to support with balance sheet. And when I say balance sheet, it's both local currency and where applicable, FCY. But I mean, regulatory wise, you should always match your funding to your receivable. So that's just context around that. We've got, and I think real estate shouldn't be seen as just creating the assets. It's a full value chain from creation of the asset land, creating the asset, going through the developmental stage. More importantly, the stabilization phase. And why is the stabilization phase is that you've got a period when we had COVID, and look, that was tough. The whole essence of real estate is the cash flows. And then how do you manage through those cycles? I mean, we're sharing slides on GDP. As much as GDP comes down, it also impacts your income from rental cash flows to sales income. So there are problems within that. And how do you then structure from a financing point of view to ensure that you're able to be resilient and weather that storm and come out at the end of the day profitably? So that's quite key. After going through the stabilization phase, what is also important is what I call consolidation. And what that really means is that now that the assets have been created, how do you monetize it? It's easy for residential, you sell and that is it. But even for that, you actually have buyers that might have bought with mortgages. So what about thinking about the mortgage rate? For assets that are not to be bought and to be let out, you've got stable assets with cash flow. So how do you monetize that? How do you create liquidity in those assets? So real estate is across that value chain, and we have to see it from that perspective. And I think that's where, that speaks to access to liquidity. And then that's where an investment banking solution begins to create value. So speaking, and I think I've shared a bit around the asset class. So I think it will be useful to just get an appreciation of the work that has been done within this market and be proud of what Nigerians are doing within the real estate space. I think that journey started from a modern and structural point of view, probably about pre-2005 with the first, first commercial retail mall. For that project, there was no debt. It was pure equity by the sponsors, Actis, and the owner. But we've seen that since that time, there's been an evolution of asset classes across retail, offices, data centers, hotels. Well, I don't think we've kicked off in that space, but that's another landmine that we can begin to commercialize. But this is just a snapshot of assets across the years, and there can be much more, absolutely much more. We can go on to the next slide. And what we've tried to show here is a pictorial representation of some of these wonderful buildings that dot our space, across Lagos, Abuja. And as well as there's a project that I should be mentioning here, but that is in there. But yeah, that just shows, thank you very much. A round of applause, please. Yeah. So, but it's the work that everyone here has done. And I must say at this point, it takes a whole village, from the developer that visionizes, I don't know if I got that English right, the project, to the project team, which is the technical team, to the financiers such as ourselves and other players in the market, to tying the dots, the legal agreements, working with firms like Detail that are passionate about the sector, and are deliberate about what they are doing in that space. So I think going from that, we'll try to share the next slide an appreciation of the different asset classes. Like I said, real estate is not an homogeneous product. It transcends even asset classes that are not yet defined. But the reality is that any brick and mortar that generates income, that's real estate. And in trying to finance the real estate, your first principle is land, the next is equity, and then there are other layers of debt structuring that you can then begin to mix into it. Now, why I said it's not a homogeneous product is that for the different asset classes, no one deal is the same. Absolutely not, because there are different counterparts, there are different land issues, tenure issues. So you have to look at, so from the broad stroke, you have to look at each asset class independently and structure around it. That's not now dealing to the specific project in itself. So using an example of retail. Retail is a bit more, and I'm just trying to share little anecdotes that kinds of positions are how we think about these things. If we think about retail, for example, quite volatile, because you're talking about maybe a retail mall that has 100 tenants. There might be a ShopRite that is strong. There might be another smaller store that's not as strong. So it's a multiplicity of different things that you are managing. The tenant mix is also critical in terms of how the cash flows come. The way the cash flows come is also in drips, probably monthly. So you have to then structure your financing, even your payment of dividends aligned to that. It's different for offices who may be stronger and might have the cash flows to pay quarterly or even annually, or even in 3 to 5 years. So that's also different. And then the profile of the tenants also speaks to the risk element there. It's also different for residential, where residential is primarily built to sell. But I'll speak to some of the funding solutions there. But different asset classes, different structures. I think that's the point we're trying to make on that slide. So going to the next slide there. Hospitality, also markedly different. Because you're not talking about rentals or a sale. You're not sure. The risk there, it is there because you're selling bed spaces, and it's not guaranteed what the income profile is. So that's where the operational management of the sponsor or the operator becomes quite critical. Industrial, that's another space. And what are you selling in industrial? You have to tie it to economic nodes. The rental indices there is different, and the profile is different from a retail or an office space. So there's an understanding of that asset class that needs to be had before one embarks on it. In terms of even managing it, in terms of the operationality of that asset is also nuanced. There then comes the special class that we call alternative assets. or alternative real estate. That can be grouped into three broad segments. And we can say, okay, education, that's a segment. And what does education speak to? Speaks to probably student accommodation, schools, universities, which can be structured and funded in a different way. And how do you fund them? There are structures you look at. You separate the OPCO, which is the operating company, the school, the management, from the PropCo, which is the brick and mortar. So that's education, an alternative asset class. Another one to think about is digital asset classes, so data centers and the likes. So also different space. You're not renting per square meter. You're talking about space, power racks, and those are the kind of indices that you're then thinking of. And then I think the last within that space is medical. And medical will be speaking to the likes of hospitals and the likes, clinics, and the like. So I think, broadly, that's just speaking to the different asset classes that you would find in real estate and how, it's different and how the real estate financing solution should be catered and dedicated to each one. Moving on to the next slide. And I, like I said, the main work was already done. So, and I'm happy. I think we must have shared slides, probably, because we didn't speak too much around, and I won't even speak to this. So let's move past this. We didn't speak too much around the macro element, but really more around the opportunities that we would see, or the opportunities and where we need to be. So I think if you can see this, I think we've been, so the first block there is stable and mature political class, and I think we've crossed that. We've had transition in government. This last one was tough, but was done, and we are all here, or like Sudan or some other place. So I think we've met that trajectory. Do we have abundant natural resources? Yes. In various forms, in various places, do we have the demographic that supports real estate, both from an housing perspective to the needs of offices, for the needs of hospital, and across all the asset classes that I've just shared? We do. Where there's a bit of a lack is positive macro environment. And, I think we are poised to see that. We have record inflation at this point in time. It might get worse, just because, with the removal of the subsidy, we're already north of 20%. Speaking to our research team earlier this week, the sense it might go up to 30%. But if that happens, you expect that towards the end of this year, early next year, begins to trickle down. On the macro side too, as well, a key element is exchange rate, because that also has a slip-on impact on on pricing. And I think we've seen that happen. So even if there was to be a devaluation, a formal and official one, I think the impact has already flowed through the economy. And the other thing we should then see is that liquidity boosting FDI and, allowing investors to come back in. Another important part is interest rate, and I think that's quite critical for our asset class. Our asset class will not thrive. That is what I say, will not thrive in a high interest rate regime. Speaking to housing, it will be difficult for anyone to take a mortgage, borrow to buy a house at 20% upwards. It's difficult because that means in 5 years, your interest has more than paid for the house and you're not started paying the principal. So that's difficult. And that's why we had seen, a bit of gravitation to USD loans because of the lower interest rate there. But even that, there has been a spike with the US Feds. I think they've come to that end. But, as at last year, June, you had the base rates, which is SOFR at 0.5. As of today, it's upwards of 5%. So even, USD loans are upwards of 10, 12%, which wasn't the case last year. You were still earning at 6%, so double. But, speaking about financial solutions, there are ways to hedge the interest rate, so that you have a fixed one, and there are structures one can look at it in USD. It's more difficult for Naira, but I believe that with time, in the medium term, we'll begin to see solutions around that. So that's just on the macro bit. So I think that's where we need to fix. And I think some of what they can go to the next slide, some of the positive sentiments which has been shared, subsidy removal, the fact that we're going to a unified exchange rate regime, the fact that there's an acknowledgement that interest rates need to come down. I mean, it starts with acknowledging what the problem is, and then we begin to work to fix that. So we believe that those would happen, and it means for real estate, because it's cyclical. If you want to ride the tide, you do not wait. You see the signs, you expect those signs will fruition in 2 years and start to build today, so that you can, well, if you start to build when the tide are setting, then you are, your gestation period, you might be out of the month by that time. Let's move. So we've talked about some of the positives that would happen. So let's keep past that and just share a bit more around, the funding solution. And this is not a modeling class, so we've kept it on the base level. If you want to understand a bit more around the funding structure, on a case by case, we can always discuss. I think what is most prevalent here in terms of structuring, it starts with the sponsor. So there are 3 key elements that as financiers we would look at, and it speaks to how you structure the deal. Sponsor consideration is very key. And for the sponsor, what are you looking at? Track record is key, and I know people always say, why do banks not, take a view, take risk? But as sponsors, which everyone is, your track record starts from what you've done in the past. So I would always advise that you start small, whichever way. Get support from family and friends. Start with 1 or 2 projects, and build that track record up. Bank lending is, I think it can be expensive. One, it's important, and I'll say no, it's always important in terms of how do you achieve a balance in your return profile. So taking equity and then leveraging that, but it's also what quantum is taking, and how your cash flows from your project speaks to it. But yeah, sponsor profile very critical. Another part that's critical, which is in here, we might have missed that, is the asset. The asset really speaks to, and remember I talked about the different sectors, or the different asset classes. So when we say the asset, I think it's been said over and over, location. But it's not just that. It's also price point. When I say price point, it's, what's the product, what is the price, and this speaking in a generic manner across all the asset classes. What is also key, so beyond that is, when you say the asset, it's the future proofing of the asset. Is this asset going to be able to generate these cash flows for 10 years or 15 years, long term? I mean, there are buildings in, the US and in the UK that are 100 years old. So I think when you start we have to think about that. Happy to see that at least, the plans, for example, if you can use that one, it's almost 2 decades, and it's been through cycles. But that speaks to how we have to plan, right? The last bit around it, the last bit around that is then the cash flows, which I've already spoken to. But it starts from the sponsor, goes to the goes to the cash flow, it goes to the asset characteristic, then that leads to sustainability of cash flows. So we'll just quickly take a look at different funding elements and structures there. So there are, I think there are 2 or 3 critical ones. No, actually more. So there is development, which is what most of us do. So there's development finance, and there's how you have to evaluate a development financing opportunity. I mean, one has to take cognizance of the structure in terms of who are you lending to. Quite prevalent is that we need to structure funding within an SPV. So that's a special purpose vehicle. So before commencing your project, it's important that even the land is bought in a special purpose vehicle. What that achieves is that you're able to ring fence, the cash flows, the security onto that project. From a financing point of view, how to take security is both taking a legal mortgage on the asset and taking a share charge on the company. So that way you can easily sell that company, which is the asset, to someone else. So, you can lend to the SPV, you fund on a developmental basis. Fund on a development basis means that, you have to take cognizance of the construction period, be it 1-2 years, and ensuring that cash flows, that your repayment only starts when the assets begins to generate cash flows. Post a developmental project, to the extent you're able to create value. So using an example, you've built the project, is income producing in 2-3 years time, positive cash flows, rental escalations, and your value of the project has grown from, let's say, 10 billion to 15 billion. Then you're able to take equity from that project and can do either create another one. So that's what we mean by equity release. So still focused on the asset, but being able to create liquidity and go on to do another project. And another critical one is sale and leaseback. That's not true. I'm not sure people in this room would, but I do think it's an opportunity, because where it becomes an opportunity is that developers developers and people that have access to funding can actually act as a buyer. So you have a company that has real estate, but ideally their business is not real estate, but they need the asset for their business operations. So a developer can actually buy that asset on a sale and lease back basis, and then the company continues to use the asset. I don't think we've employed this enough in this market, but I think it's so prevalent. And given the kind of assets, companies that need it, it creates funding for them to expand their business. And even for a developer that has a portfolio of real estate, am I looking to list as a REIT, it creates that option. So that's something to also look at. Speak more around the residential space, but I'm sure we've had this talk already. But we believe from a Stanbic IBTC point of view that the biggest segment of the market remains this. So while we've got our teeth in some of the other asset classes that I shared earlier on, where we think that there will be a lot of developmental impact, positive growth, employment generation in this market is within the residential asset class. Now, recently a key reform was done from a pension standpoint where, employees are able to extract 25% of their pension savings and can pledge that as equity into to get a mortgage. So that remains a critical element that unlocks at least the equity piece and create. Okay, it's fine. Thank you. I've got 5 more minutes. Yeah, I should round up soon. Yeah, so that creates that opportunity. And Stanbic is willing and able to work with as many developers as can create a product along this path. I think what to explore here tangibly, and if we think about it, you've got firstly two sides, demand and supply. Simulating demand, being able to utilize being able to utilize your pension funds to deepen equity. At the same time, having a mortgage bank to support you. That is critical. Now, on the supply side, being able to work with, be it Stanbic or any other financial institution to provide funding to create the assets. You can see that it's a full locked-in ecosystem. So that is an area to begin to explore. Housing in ISA or residential asset class globally, it's said to be up to about 70% of all real estate. That's just the simple truth. And that begins to up to, population to create wealth. In closing, I think I'll summarize by saying, look, positively, I think we are on a positive tide. And the expectation is, over the next 2-3 months, once there is clarity in terms of macro policies and what the government plans to do, despite the first subsidy impact, and there's going to be some impact there, and also on, if we think about it, what that could mean for disposable income. The reality is that there is a need. Real estate plays a role in accelerating economic growth and development, creates wealth, creates income. And to the extent that there is scarcity and demand, then one is to think smartly around product offering and ensuring that it caters for the market. Whether subsidy goes up or not, people will need homes. Whether subsidy goes is there or exchange rate impact is there, there will be retail because people would shop, people need to eat. So that's how we need to think about it, about where those opportunities lie. From a real estate financing point of view, development financing, it is there. We've supported projects in the past. It's our bread and butter. And we're happy to sit with as many developers to find solutions to how we can support you. There are structures that we look at. What is more important is to ensure that there's a full ring fence. Cash flows are there. The sponsor's profile is right. And the project or the product is fit for the market. Talked about equity release, talked about the sale and leaseback opportunities. So please let's begin to explore this. The residential asset class is key, and that is an area we should all watch out for and begin to expand across different nodes. What we're looking for is successful partnerships with real estate firms, which we've worked with in the past, and we're looking to expand on. There is appetite and capacity to deliver funding packages in an efficient and timely manner. Our corporate governance structure allows us to provide that solution, working with different parties, legal firms, and other parties within the ecosystem. And over and beyond our real estate financing, there are also other solutions within the group that creates an end-to-end financing solution. I think on this very note, I'd also like to thank everyone for listening, and happy to take any questions, maybe post the panel session. We'll share the slides, and that can be shared with the rest, with the audience. Thanks very much.
Thank you very much. Please, a round of applause for Mr. Tola. I want to thank you for a very insightful session. I'd like to ask, have you ever thought about taking up a role in lecturing? Okay, so at this point, we'll have a 5-minute break just so you can have some tea and coffee. and stretch. So please. Okay, so please, the attention of the owner of a white Range Rover with registration number EPE 321HJ is needed outside. The owner of a white Range Rover.
Thank you. Thank you, everyone. Please, can we start settling down now? Thank you. Please, can we start settling down? Coming back to our seats for the next session. Hello. Please let's settle in so that we can have the next session. We can begin the next session. Thank you. Okay, we're still waiting for a couple of people to settle down, and then we can start. Okay, thank you, everyone. Thank you once again for coming. My name is Olaomi Alade. I'm an associate partner here at Detail Commercial Solicitors, and I head the real estate team here in the firm. Now we are going into our panel session. This session we intend for it to be an interactive session. We're going to be discussing real estate financing, and my speakers are here. You've seen Tola's presentation. I think it's giving you a taste of what's to come. I'm excited personally, and I hope you're all excited. I'm open to learning and hearing all the new and innovative ways our experienced speakers would be, sharing with us. Without further ado, and I'll be introducing or inviting my speakers to the stage now. I'm inviting Mrs. Sadia Aliu from Urban Shelter. Please give her a round of applause. Thank you. Next, I'm inviting Ms. Erefemi Akeredolu from Cardinal Stone. Please give her a round of applause. Yes, it's intentional. Ladies first. Next, I'll be inviting Mr. Adetola Nola from Veritasi Homes and Properties Limited. Please give him a round of applause. Thank you. Last but not the least, I'll be introducing Mr. Tola Akihome from Stanbic IBTC. Please give him a round of applause. Thank you. I'll take my seat now and we can kickstart the session. Welcome, welcome, welcome. Thank you, guys. Thank you. I personally know that you're busy, and this is a sacrifice coming here and, taking out time. I cannot overly thank you enough. So every time I say thank you, please indulge me and let me just allow me to say the thank you every time. Thank you very much. I would start by introducing Sadia Aliu. Sadia Aliu is the MD CEO of Urban Shelter Limited. Urban Shelter is a leading real estate development company renowned for its project conceptualization, development, and management. The company specializes in residential, commercial, and retail projects with the goal of creating neighborhoods and transforming lives and skylines. Mrs. Sadia personally provides governance as a board director in a number of companies, including Urban Shelter Suites and Hotels, North South Power. She's passionate about gender equity, sickle cell disease awareness, mental health, and lends her voice to a number of NGOs as part of her civic duties. Please give her a round of applause. Now I'm introducing Mrs. Erefemi Akeredolu. Mrs. Erefemi is the MD CEO of Cardinal Stone Trustees Limited. She is the Cardinal Stone Limited. She was head of private trust at United Capital. She has over 14 years of experience in trust service, asset management, private banking, wealth management, and financial planning. Please give her a round of applause. Let me use this opportunity to say that Mrs. Erefemi has been very accommodating of me. She also gave me pointers in us preparing for this event. Thank you very much. Next, I'll be introducing is Mr. Tola Nola. Mr. Nola is the MD CEO of Veritasi Homes and Properties Limited. He's an esteem-driven and innovative entrepreneur who has played a pivotal role in redefining success within the Nigerian business landscape. Mr. Nola is an exceptional entrepreneur dedicated to the growth of business in Nigeria and beyond. His visionary leadership, extensive experience, and commitment to fostering entrepreneurship makes him a prominent figure in the business community. Thank you, Mr. Nola. Last but not the least, we have Mr. Tola Akehame. Mr. Tola is an investment banker with Stanbic IBTC. He heads the real estate finance at Stanbic IBTC PLC. He's been actively involved in several real estate industry advocacy committees set up to engage key regulators to unblock constraints to catalyze the growth and development of real estate investment trusts and create an affordable housing solution. He's a regular speaker at real estate conferences and industries events, both locally and internationally. He's a member of the Urban Life Land Institute. Welcome, Mr. Okay, so to start our discussion, I would have a few questions I want each person to take generally. Let's start with giving your, so I'm starting with, are there regulatory changes that impact real estate business that you like to see in coming years? Regulatory changes that you like to see in the coming years that would impact real estate business? I know that, Tola, you spoke to some of them earlier in your presentation, but are there things that you want to share with us that, that you've not mentioned from your presentation? And then we'll go to the next speaker.
I wasn't expecting to speak right afterwards. I was hoping to take a break.
Let me give you a
No, it's fine, it's fine. I can lead. Fine, thank you. Yeah, I think from my perspective, and I had that debate with someone recently about what role private sector and what role should the government play within the space. So the reality is that we need, a congruence of solutions on both sides, and there has to be alignment to ensure that the right changes are done to stimulate this space. Naturally, with the right policies, the market would find itself. So thus far, and we have to be not be grateful, but we have to recognize that it takes advocacy, it takes collaboration with government to unlock certain policies and changes that we need. So we need to firstly identify what those bottlenecks are, what those constraints are, and then form advocacy groups to resolve it, working with government. One key one, and I mean, you mentioned it in my profile reading there. We commenced work with the SEC, the FRS. I'm talking about like 2010. It took 7 to 8 years to unlock some of the policy reforms that had galvanized REIT. And, the REIT asset class was an instrument. It's critical to creating that liquidity once these assets are formed. So that's a good example of, working together with government, traveling to Abuja, having breakfast meetings over many years, in order to unlock that. Another critical one is the recent pension reforms, right? So equally positive, and we've seen it. Recently, towards the end of the last Minister of Works and Housing administration, what was released was the National Housing Strategy. I'm yet to read it, in depth. It's a 120+ page document. But it's important to see and understand where the mindset is, and was put together by reputable institutions such as the FMDQ and Pricewaterhouse. So it's important that we look at that. If there are gaps, we can always address it. The more important catalyst that I would say for real estate, and where you can, because I mentioned that, look, from a pricing point of view, interest rate point of view, it's expensive. And the advent, you've seen other sectors add favorable interest rates, intervention funds and the likes. Real estate that didn't see that. The government language that there will be none of those specialized or discounted rates, but to the extent there is one, then we should create one especially for real estate. That will be primary, because that will stimulate, more Naira lending and make it competitive. Because some of the funds that come into the market are offshore funds at low interest rates. So if we can also galvanize that within our space, that will be first prize. So that, I think that interest rate reform, either market driven or as a stimulus would be quite critical.
Thank you, Tola. Yes. Okay, Mr. Tola wants to go.
I just want to add a little bit to what Tola earlier said. He has come from the perspective of a finance person. I want to come from the developers because I actually thought that you're supposed to direct the question to me or to her. But yeah,
So it's for everybody,
I was
actually.
just joking, actually. Okay, so I'll cite a few examples, right? So in year 2019, we launched the project, told people to pay I can't remember, I think 10% because the Federal Mortgage Bank was promising that they could finance mortgage for people trying to bridge the gap for ownership in Nigeria and all of that. We did that, got some 5 million and 10 million from different people, almost 100 people. I just like to tell the story so people can relate, you know. And in 2019, 2020, 21, 22, 23, the prices of it's even almost impossible, even if they disperse the money for us to build at that cost, at that particular cost again. So we had to refund. We refunded close to, if I'm correct, 500 million naira because there are so many bottlenecks, bureaucratic bottlenecks in, with federal mortgage. I don't know, maybe urban shelters will be able to get money because they're like very close to the government, but it was almost impossible, you know, kept paying a lot of money that was unreceived and all. So these are some of the policies that I think, you know, regulatory policies I think the government can change. Another thing is, just last week, I don't know what I'm doing for the company, but I think I'm consulting for them of a commodity company at the rice, trying to do like a rice mill. And, you know, we had not even cited this rice mill. And then we already have some funds called CBN intervention fund at 9%. And then it was looking like they were trying to throw that money at us. And I'm like, look, these kind of funds are not even available in real estate. Why do we get funds at 20-something%? You know, because I have done projects that it's not even worth it to do it again because the cost of funding the project is still it's like working for the banks. So the policies are still, you know, I think to start with, the Federal Mortgage Bank needs to be, you know, a bit reformed. And then there should be something like, I don't know if there can be something like a bank of real estate, like Bank of Industry, because when you go to BOI, they tell you, oh, we don't finance real estate. Or if you have finishings and furnishing, and all of those things. So I'm just trying to be very practical. So I think these are some of the things that I want the government, and, you know, talking about maybe approvals, the ease of getting approvals and, you know, perfecting titles and all of these little things. And then if that's easier, then, you know, home ownership can be really awesome.
Okay, thank you, Mr. Nola. I will go to Mrs. Sadia now. I would like you to answer the question, but I would like you to come at it from a perspective of why is financing not easily available in terms of policies? Like Mr. Nola mentioned that, you know, you go to a BOI, for example, and they say, oh, sorry, we don't finance real estate. So we're talking of policies, but can also, you know, mention or talk a bit about why do we have this bias, if I may use that word, for real estate finance?
I appreciate the word you're using, which is bias. There really is a bias when it comes to real estate. It's looked upon almost as a real man's game. So in the last 8 years, we've had huge intervention in agriculture. You've had intervention in power with the payment assurance guarantee. But for some reason, when you mention mortgages, it suddenly funding becomes a very dirty F word. Everybody wants funding. And if you're not lucky to find a Stanbic, then you're having to work with the bank that you're donating your firstborn child, you're mortgaging future generations of your lineage. And it becomes very complicated. I completely, you know, agree with both my colleagues on this table. I think we need to change that. And when you mention regulation, perhaps this is to say, what reactions do we want to see or expectations of the government? I have a love-hate relationship with regulation. At its best, it's something that can help fast track, organize, sanitize an industry. At worst, it is inefficient. It adds a layer of complication. It adds further bottlenecks, potential for rent seeking and bribery. And I'll let you all come to a conclusion on what tends to happen for the Nigerian story. So I'm not crazy when we use the word regulation, but in terms of policy, we need an interventionist approach for real estate. And I think for both demand side and supply side of things. For me, real estate is far more of a challenge, or it's far more of a finance issue than it is of a bricks and mortar thing. So when I saw your business series was focusing on this, I thought, gosh, yes, they're putting together actually the crux of the matter. Most of us here can build 10,000 houses. We don't build 10,000 houses because there aren't 10,000 Nigerians that today can afford to buy a property. We're one of very few nations that you're expected to bring 50, 20, 10, 100 million naira to buy a house. Anywhere else, including our cousins, by the way, in West Africa and East Africa, there are mortgages that are relatively, if not comparable to European interest rates that are possible. And I agree that fine, we're in a context where inflation is at 22%. CB and that committee every couple of months wake up and they say add an extra 1%, an extra 0.5, and we've gone in the last 8 months from 11 to 18%. So I also understand that Tola and his colleagues are in a really difficult position. But if interventions can be done for agriculture, can be done for power, then we should also do the same for real estate. Mr. Jimide's presentation, I love it because nobody picks on the fact that the transformative potential for real estate when it comes to nation building and growing economies. Now, it's not a mistake that you see a lot of European countries and the United States in particular are known for this. Whenever there's a tremor, a downturn in the economy, they pump money into real estate and construction. They pump money into real estate and construction because everybody from the lovely mama put that starts food at the beginning of a construction project, that's her job for 2-3 years. Her kids are taken care of just because she knows the footprint, footprint? No. People going in and out on the side. Everybody to the legal teams, the other services, to the actual construction, to manufacturing industry. If I know that Urban Shelter is building a 100 house estate and they're going to need, I don't know, every 3-bedroom house, let's say, has 10 doors. They're going to need 1,000 doors. I just need to set up a factory close to them and keep supplying. And these are just minor things to mention about how real estate or how construction can be really exciting in generating incomes and generating employment. But back to your question, I think we should change this kind of idea that somehow real estate is a rich man's business. We assume real estate is $1 million home in Ikoyi. It can be me getting my open store 500,000 naira. And I'm trading in tomatoes, I'm trading in vegetables, and that helps to pay school fees. And I think when we put it in that, then we realize actually it's something that we can get everybody on that first rung of a ladder. It tends to now not be just this one asset, but it's an asset that you can then use to also unlock other potentials, like Tola mentioned in his presentation. I'm sorry, I'll give space to other people. There's so much more they can be doing apart from obviously CBN intervention, but also looking at other aspects of PPPs. I agree with you about trying to minimize the time and the cost of transferring titles of even just paperwork in terms of that. I'd love to see a review of the Land Use Act. It's incredibly inefficient. I appreciate that it gives every Nigerian the right to property or the right to apply for land. But when the governor or the FCT minister has to be the one to approve everything, you don't have that time. Time is actually money. I'm sure Madam has things to add, so I'll leave that in that.
Thank you very much. Yeah, so the same question, but I would like to, from piggyback on back of what she said, with the, with a view of looking at it from the whole ecosystem and how real estate, if paid more attention to, can help with how do I say, financial empowerment, talking about from the person setting up factory, for the person selling food, the whole thing, the whole ecosystem, vis-a-vis, government policies.
Thank you. So like you said, piggyback on what she said, I think it's mostly around the well-being of the populace. The real estate sector is, the value chain or the ecosystem is so large, just as she has explained, that it can affect different people in different spheres, not even the construction company or the investors or the buyer of the asset, but all the people within that ecosystem. Tola mentioned things around policies, and I think that's pretty much important because when we look at real estate critically, funding or financing is a critical aspect of it. And if you look at the banking sector right now, I think maybe majorly you have 4 banks, Stanbic being one of them, if maybe not the largest, that, focus on real estate or has real estate desk dedicated to this purpose, right? And sometimes you can't even blame these banks really or investment houses because there are no policies that can spur or, incentivize the bank to provide financing, right? And then when Nola was speaking, the interest rates or access to that capital is then very stringent, because as an investment banker, you're looking at different parameters, risk management, viability of the project. You mentioned the track record of the real estate company and all of that. But if there are policies that can help mitigate some of those risks, or there are things that protect investors, for example, maybe the channel wouldn't just be in the banks and the investment companies, but it will even be individuals that can, invest directly or indirectly, because they know there are rules and policies that right, that protect the investors. And at the same time, there are incentives for the lenders vis-a-vis the real estate companies. For example, tax incentives. If a bank will lend to a real estate company for a long term, I don't know how many banks, maybe Tola can correct me, that will give loan for the next 20 years, not mortgage now. I'm not speaking about mortgage, but your typical debt, maybe 10, 15, 20 years. I'm not so sure such things are available, but abroad you have all those things happening, right? So yes, we will still come back to policies that can help, and then some restructuring around national housing policies. Like she mentioned, Land Use Act is another problem, right? All those things need to be revamped for us to now then speak directly to how we want things to go when it comes to real estate. Thank you.
Sorry. Thank you. Thank you. That was very insightful. I'll come to you now, Mr. Nola. Yes. From your general experience, I know that you've gone to the capital market before, you've done some transaction. So I went from your general experience, do you prefer debt or you prefer private equity capital market for raising money for your projects in real estate? And give us your reasons why you prefer.
So for me, though, I think it depends on the kind of transaction you're trying to finance, real estate you're trying to finance. So if you, for example, when we went to the market to do a CP, you can not normally use a CP to finance a construction project that takes like 2 years, 3 years. So one of the reasons why we did that CP was we're doing site and service. Site and service is buying large tracts of land and fixing the infrastructure, which we knew we could do the infrastructure in 5-6 months. And then of course sell, and we're able to redeem that just because we put the money in site and service. We would then, if I was building a 20-something story building on Gerrard or Borderland, I would not be crazy enough to go raise money in the commercial to 70 days money. So I would probably go for like a bond, or I don't think bank loans should be used for real estate, to be honest. I think that it should be used as a bridge finance, and then you quickly refinance it and get out of it. Because I mean, first of all, talking about the floating interest that your projections are, you cannot never be very accurate with your projections, because the interest, I took money from Globus, I think some 2 years ago. They've written me at least 4 times about interest rate change. Every time Emefiele announces of MPR rates, the second day they are writing me, and then so I do not think anybody should use bank loans for to finance real estate project. However, I think that it can be used for like bridge. Look, let me cite an example of a structure that I actually designed so everybody can understand. So I want to do an hotel project. Let's say you want to do a hotel project. Okay, so let's say you don't have any money, or you have very little money even from the land. You don't own the land. So you can say, I just want to paint a scenario with which you can use a mixture of debts, equity, dollar debts, all of those, capital market, everything on one project. So let's say you own the land. Let's say you don't own the land, or you have a bit of money to, so you go to the bank saying that, oh, look, I'm trying to buy this land for 5 billion. I have just 2 billion they'll give you, correct? But you know that you shouldn't stay on that particular debt for more than a year. You quickly need to exit. So maybe it's an SPV that you use to raise the money. And then maybe you can then go to the market, do like a private placement, get some money and then offset that loan. That is like a form of equity. I don't know if I'm not correct. Stola can correct me here because like this, there's the expert in real estate financing here. And then say you're able to do that. And then you can then, if you have very good track record, good corporate governance, all of this, you can then go to the market for bonds or dollar debt to build the carcass of the structure of the hotel that you're trying to build. If you're done with the carcass, I have raised money from BOI to furnishing and finishings before of a particular project. I think we raised the money at 12%, if I'm correct. So you can then, when you're done with that, you can then refinance that particular bond with money from BOI at 10, 11, 12%. So can you see that on one project, this is like a mixture of debts, dollar debts, Naira, equity and all, and then you are able to exit the project very fine. And because it's not possible to stay on a 20 or something percent debt and be running hotel. From every financial projection and forecast that I've done for hotel, you will not be profitable. In fact, in year 5, you're going to fail, So it depends. So going back to your question, it depends on what you're trying to do. If you're trying to do side and service, you can do commercial people. If you're trying to do very long-term projects, you can do bonds. If you're trying to do, you can do bank loans. They have their disadvantage, advantage. In case of bonds, the interest rate is very fixed. It's not floating. You can do your predictions very well. And then if it's not and because it's not term loan, so you're not paying every month. So you are able to do your business, focus on the operation side of things. In the case of bankless, however, interest rates can go up and down. You have to pay per month if it's a time loan. If it's a time loan too, I think you have to pay interest and pay the capital at the end of the project. Banks will not naturally give overdraft for real estate projects unless in special occasions. So they have that advantage. However, you can mix all forms of financing on one project depending on that project that it is.
Thank you. That was insightful. I'm coming to you, Tola. Please, I want you to address something you mentioned about he doesn't believe that you should come to the banks for real estate financing per se, other than using it for like a form of bridge financing.
Yeah, I think he didn't actually say that. Later on, he corrected himself. So I'm going to talk about 3 things. 1, positive leverage. That's valuable. Positive leverage allows you to multiply, and you have to manage, how I call it positive leverage, and leverage means debt, is the same thing. And it touched on that, right? And that'll be my second thing. But positive leverage is critical. It's tantamount to the same way an human being, a person, would take 30% equity and buy a home. That asset increases in value, takes equity from it, and multiplies wealth. Is how it's utilized. Positive leverage. And positive leverage means your and despite so it means that your income exceeds the interest payment on that asset. So you imagine that you've taken leverage and you're able to rent the home for, let's say, 4 million, but your annual interest expense is below that. Positive leverage, right? So but you have to take a long-term view on real estate and have, you have interest rate curves and you monitor that, you model it out. And that's the value that we bring. And there are also mitigants and how you can hedge interest. Maybe fix some, have a floating portion, but you're hedging it. So that's the first part. The second part is capital structure. You should never, ever take debt. No one will, I won't give you debt if there's no equity. There's a balance. So remember, I spoke about capital stack, equity, land, some of your own skin in the game. The right debt, your debt should be profiled in such a way that it can service itself, wash its face, and you won't be out of pocket. No, you know, and if you have to be, there has to be flexibility in the structure that allows you to restructure or refinance the debt. You know, there are different forms of debt you can have. There's MES, there are zero coupons, there are different structures. So it's about the capital structure, the type of asset. And remember, I talked about asset classes and what each deal is different. You have to tailor your financing solution to the particular project. It's as simple as that. You've worked on a few now with us. So yeah, so it's key. What's the capital structure and what form that takes? And it goes to Nolo's point in saying some equity, some debt. And remember, for residential financing, it's 1-2 years. You know, there's equity, there is pre-sales, and then there is some debt. You know, it's for 1 year, and that's bridge funding. You know, I mean, whatever way you would call it, but because that's a build to sell asset profile, so you tell all that. And then the last point is deal structuring, having positive leverage, having the right capital structure, and then structuring accurately with all the legal shenanigans, you know, and the right legal agreement that allows you to also remember real estate. So for build to sell is 2 to 3 years max. If you have a project you can't finish and sell in 3 years, that's a problem. That means the product is wrong. The price point is wrong. For commercial assets, they have a long gestation period. They are long term. It goes to what we said, that 20-year money. Yeah, those are the platforms. So I hope I've been able to address and I will give you money tomorrow.
That's what's it. Thank you very much, Mr. Dollar. Irifemi, I'm so sorry, pardon me. Tola, thank you. Yeah, both Tolas, yeah, that's why it's sometimes. Coming to you, Irifemi, from Mr. Dollar's contribution, he had mentioned things about, he had mentioned bond and almost like the whole works for accessing finance, you know, using everything, maximizing all the available financing options to carry out your project. And he mentioned, he spoke a bit about the bonds. And I know that, so what I'm trying to ask you is that for bonds, it's not just anybody that can access this thing. Can we speak to how these real estate developers can access the bonds, what is expected of them, and how available, or how can this be structured in such a way that it favors the developers and in the long run, the off-takers?
Okay, thank you. Right, it is tough. So maybe I will start from how it favors the developers. Tola just spoke about deal structuring. Yeah. So let's look at bonds from the perspective of what are you even trying to achieve? You are trying to access long-term funding, obviously. Nola also mentioned something about, you know, is at a fixed rate because you pay the coupons over a period. So let's take a classical example of, let's say, 20-year bond or 10-year bond. You pay coupons periodically, let's say semi-annually. And then depending on the kind of structure it is, if it is amortized, if it is balloon structure, whatever kind of structure, you pay maybe principal and interest at a point, or you pay principal at the end of the tenure. The truth is, all of these things we're talking about ties into macroeconomics, right? The interest rates or whatever you place on the bond as the return to investors is a function of what is happening within the economy. It's a nucleus, so you can't be an outlier, right? So the market can be at, let's say, for example, 22%, and you want to raise capital at 10. That would have been favorable to the real estate company, right? But it might not be possible. And there are other parameters. What is the rating of the real estate company? How viable is the project? How viable, what's your track record? What are the risk management issues and how are they going to be mitigated? Those are the things that typical investors or lenders will put into consideration before they can even speak about funding. And it's the same thing for bonds. So by the time you do your rating and your rating is not investment grade, of course, investors will factor a premium into it to say, I can't give you money at a low cost because, you know, you're not investment grade, right? However, these opportunities are there, and with working with the proper legal and regulatory framework, as well as financing framework, you can then work out a situation wherein maybe it will be hybrid composition of different things. It might not necessarily just be bonds. You might look at REITs, you might look at notes, right? You might look at bridge finance. And speaking to what I do on a day-to-day, that's where a trustee comes in. So a trustee then helps you when you have worked with your financial advisors to see how the objectives you have set out can be achieved. They then give some level of comfort to investors to say, he's not going to run away with your money, or he's going to do what he has said he would do, because the trustee will also oversee the project in question. So it's not just for you to raise capital, the use of the fund. The trustee then looks at it based on milestones to say you are utilizing the fund as you are expected to, then your returns or your cash flow projection is coming in as expected and returns are being given to the investors at due time. So access to the market or bond or notes or REIT, whichever case, is not the issue, right? So if Nola comes to market to rate a CP, for example, and he paid in due time, there were no issues. The project was delivered right on time. If he's coming back to the market, he has that track record. Investors are quick to say, oh, we know him. He had done this before. Lucky him, he used a trustee like Cardinal Stone trustees, where we then help you, you know, to ensure that your interests are all protected, you know, and at the same time, is able to build some level of accountability and transparency because he has, done this before. So it will be favorable to him in what he has done, accessing those financing options, and at the same time to the investor. But you cannot take out that market element in it, that is whatever is happening in the nucleus that also affects what it's doing in raising capital.
Thank you. Mr. Nola. That was
I just quickly want to add to what she said. So she said that if Mr. Nola went to the market last year, paid back, came back to the market, tried to raise money, it will be successful. It's not totally true because we tried that. Yeah, so last year, we went to the market, we raised money, we paid back 1 week before maturity date. And then we came back to the market this year. While we were doing our roadshow, however, before then, a real estate company had just defaulted, not one, actually two. I don't want to mention their names in their, and that automatically affected Veritasi. And then I don't really even know this real estate company, So I'm wondering how sensitive, because look, if a real estate company go to the bank, get money, and don't pay back. If I go to the same bank will still give me money. So you can then say and agree with me that the ease with which I raise money in the market is not only dependent on my track record, but other real estate companies' track record, which is insane. So these are some of the things that you should consider when you want to go to the market for funding, and for the sake of the developers in the house, because a lot of the developers are here actually. Cardinal Stone is one of the best trusts. I've never used Cardinal Stone. Clap for them anyway. But yes, so so talking about so talking about bonds and structured notes, all of these instruments, and I think from from my experience in the market, I think corporate governance is very important. Corporate governance, track record, rating, actually investment grade. I've never seen anyone that raised money in Nigeria without an investment grade rating. To be honest, you can correct me if you've seen. So I think that the investment grade will start from BBB, correct? Yeah, so from BBB. So when you get your rating, you have good corporate governance, you have good track records, and then people like Tola, you are able to go to the market, and depending on the project that you're trying to finance, and do like a CP or a structured note or a bond. However, you can then know that you can be affected. Veritasi go to the market, get money, don't pay back. If Adozillion goes to the market, then because Veritasi don't pay back, probably would then affect an Adozillion not to be able to raise money. That would not, however, happen with the banks. So these are, I just wanted to, because you said that, I just wanted to, yeah. So thank you very much.
Thank you very much, Mr. Nala, for that contribution. I'm coming to you now, Sadia, and so I wanted to say that, okay, from what Mr. Nala has said, I think it goes back to the bias we're talking about in terms of, now you're not looking at this real estate company just on its merits. Yeah, also is that real estate company is also affected by the performance of other real estate companies, which is not the same for other industries. And because of this, I know that real estate developers or real estate development has had to rely a lot on off-takers. Can you tell us about what has been your experience with off-takers payment plan, and how has Urban Shelter dealt with defaults to avoid either delivery defaults and recoup their investments, and also if it had to rely on any sorts of financing vis-a-vis relying on off-takers to also be part of that financing, talking about the whole, using your whole option of financing to deliver your projects?
So my approach to off-takers is intense gratitude, because one, they're trusting their money with you. And I think beyond choosing who you're going to marry, the next important decision you make as an adult is where to purchase a house. So deep gratitude is one. But just like the whole panel mentioned, it's not as straightforward relying on one particular stream of financing. And I think it's actually quite dangerous to think that that's the way to do it. And perhaps to speak to when you say there are developers in the room, perhaps there's that over-reliance on one source. There's some projects that sell themselves. They spontaneously there's a rush of it. There's already kind of a backlog of clients. You're moving, say, from a first phase to a second phase. And I think you've experienced this, where you don't need to look at various, financing avenues. To give context, Urban Shelter, we are on 15, 16 project sites across Nigeria. 3 in Kaduna, 4 in Lagos, and then I think about 8, 9 in Abuja. Yes. Or we run concurrent projects. Our products are from, thank you. From 5 square meter shops at 1.5 million naira in Kaduna to site and services, and again in Kaduna. If you notice, you do the product that suits the market. Obviously, I wouldn't go and do a $1 million home in Rigachuku, Kaduna, to Lagos, where you're going up because it's Lagos. There isn't that much space. In the backyard we have in Niger State, largest landmass, obviously you do what suits that particular area. But essentially we're on 15, 16, 17 project sites. They run concurrently. Our strength, I think, is in that diversity of having different asset classes for different people, so that when you walk in the door, there's something that suits you. So even in residential class, starting at a 6-7 million naira studio home, all the way to 700. So whatever suits you, it can. And when you look at that diversity, then you cannot say, oh, debt is particularly better than equity. With a mezzanine finance, or you're going for a corporate bond. Incidentally, we haven't done a corporate bond. And part of it, I think people like Tola know when we're about to do one, and they quickly reach out and say we have better options. Because every time we're close to going to the market, either the macroeconomy doesn't work out, which we're experiencing in the last 1.5 to 2 years. What happens with 1 or 2 real estate companies kind of dirtying the waters, that somehow affects you as well, and that becomes an issue. Or you end up with a bank that you have really strong ties with, a financial partner like Stanbic, that says, well, actually, we have a fantastic product for you that can work in your favor. And again, he's here, but I'm not saying it because of him, but you're absolutely right. There are only about 3 or 4 banks you can go to that really understand development finance, project financing, and also have an appreciation on the mortgaging side of things for demand for clients. And Stanbic really are the forefront of that. So I have to appreciate them. So there is no singular financing option. When you come into investment decision-making process and you align all those figures and you see what works for that project, that's what you choose. There are some that are not even going to be that. You're just doing a CSR project for Nigeria. You're providing homes for police. You're going to give them at 5 million. You're going to give them at whatever that price point is that allows you to just break even and have Fanta. At the end of the day, you're not going to share bonuses for that 3 months. So again, it's a decision-making process, and it's geared towards either the project itself, or it's actually geared also to the client themselves. But in our case, I think because of the strength of that diversity and we're not over-reliant on one particular asset, it balances out quite well. It's a challenging juggling process, but it's certainly one that as a team we enjoy.
Thank you very much, Mr. Debe. So I'm going to ask a general question. In all you've mentioned, when each of you, when you were speaking, I noted that you had said something about ratings, you had said about the kind of project. You had also mentioned that depending, you were about to go to the market for a bond, and then sometimes people like Tola would reach out to you. And it speaks to your pedigree as the kind of business you've done and your pedigree in the market and what you've been able to achieve. For an up and coming developer, what would you say? So, and this is to everybody on this panel, what would you say are the pointers for a developer to do or engage in, starting from structuring the business properly to, whatever the points, contribution the panel would have to them, getting a good rating, for example, to be able to access this market, getting projects, being aware of the kind of project. From the banking perspective, what would the bank be looking at in terms of track record, in terms of being a sponsor from the trustee? How do you come in? What would you be looking at in terms of how this developer or the real estate company should go about achieving this, especially if it's, let's take it that this is a first-timer real estate development company just coming into the sector. We're starting with Mr. Nola.
All right, thank you. So I would say that from my experience, depends on the strength of the consortium with which you've taken to the market. When I say consortium, I mean the trustee with which you've maybe start from the arranger of the instruments, the arranger, the solicitor. If you go, let's say, I don't want to mention any arranger, but I can mention detail solicitor as going to the market with a detail.
They didn't hear at the back.
So, and then also what we usually do going to the market, say we're trying to do a notice, have like a good debenture with a trustee, and then before now we've used UTL trustee, but when I get back to the office now, we'll start using Cardinal Stone. And then of course most of the time I know that when you go to the market and if you're trying to secure your bond, and let's say you're trying to use a debenture, the credibility of the trustee that you're trying to use, or if you're trying to use the bank BG, there's no way. I think when I was talking to Anita about the new pension stuff that she was saying, and then she said, don't worry, Stanbic would give you construction finance. And I said, yeah, I mean, even Stanbic BG, if Stanbic gives me a BG and I take to the market, I'll raise money like this. So it's probably Stanbic don't even need to give me money. So for new developers that are trying to go to the market to raise money, I'll first of all say, whenever I want to advise anybody, I'll say your audited accounts and corporate governance should be very correct. It's very advisable to use the Big Four. At least they are not that expensive. I just got to know that. And then when you use the Big Four, then you get your solicitor, you get your trustee, get a very good arranger. If you want to secure the bond, you have like a bank guarantee, and you go with this very strong consortium to the market. I think that the market would fund, and it's almost the same thing also as trying to get the bank loans. I think with bank loans, however, 50% of the reason why you get a bank loan is the people that you know in the bank, but
Sure.
I'm just, I'm just trying to be very, you know,
Tola is here. Tola is here.
and this is the reason why I'm trying to, so, 50% of the reason why you actually get at least good money is the people you know in the bank. So they'll try to work from answers to questions with you. They'll say, oh, do this, don't do this, bring this and all. Not that you still not do anything, you do stuff, but I mean, you have that guidelines from the people in the bank. However, in the market with the investors, you put a very strong consortium, good arranger, good trustee, good security, solicitor, and all of this. And yeah, you would attract money. So what I would always say to young developers, or I'm still a young developer, so like with developers that are starting out, like Tola had rightly said when he was presenting, you need projects. You need 1 or 2 projects to start with. You can't just start, you need 1 or 2 projects that you've delivered, even if it's just 4 units of something in Lekki, and then you do another one, it gives you a track record. And then your books have to be really tidied up, from your solicitor to your auditors and to all of this, the good business plan, what you're trying to use the money that you want to raise to do. And then of course, maybe you have a good trustee that is backing you up on the deal, and all of this thing put together from consortium to go to the market. I think the market will respond to that. This is what I'm just trying to say.
Thank you very much, Mr. Nola. I hear you say that we cannot underestimate the role of professionals for the developers to achieve this. And what I would like to add to that before I take Sadiya's contribution is that I would say that we shouldn't wait till the end or till there's an urgent need before we hire our professionals to, I would say that let's get the professional advisors right from the scratch, to help us grow and to build. I also like that in us talking about this real estate financing, it's important I'll just reiterate what Tola had said and you had said, it's important to get a project running, family and friends, do something, and then, but while you're doing that, have a structure in place, have a long-term plan, work with your professional advisors to help you achieve this, because, we're going somewhere. But I would take Sadiya's contribution now.
Thank you. And this is on new developers trying to get into the, So since Nola has covered, I think, kind of what I call the formal approach, if you're trying to raise money from the capital markets through a corporate bond. A lot of us don't realize, I think, the level of network or influence of people that are around us. It might be from these events we go and we pick up complimentary cards. If you're one of these people that you're newly on the rung of the ladder, form yourself a mailing list and build up some kind of an information sharing system about what you're about to do. Make it exciting, nice presentations. You'll be surprised that there is money in the economy. So what I'm looking at is internal, I don't want to call it international investment because it's Naira denominated loans, is you and I, the rest of us, cousins, family, friends, associates that have money. People would be willing to invest because the last couple of years where inflation has been heading and interest rates moving and the options for investment not being particularly exciting. In nominal terms, it's growing, in real terms, it's actually not. You'd be surprised at people that are willing to take a risk at a developer to say, I want to fund this 500 million Naira. If it's 500 is too much, look for 10 people that are going to give you 50-50. Look for 20 that are going to give you, I've lost the mathematics, but I hope you understand my point. It's if you leave here, like I said, most of you, this isn't the first time you're joining Detailed Business Strategy. It isn't the only one of these kind of forums you're going to attend. It's really easy, things like MailChimp. So you might not need to go to that formal route. If you raise 100 million just on that, then you can even have that, what we've been talking about, having a history to be able to show I've been able to raise 100 million Naira. By the time you approach your consultants, they're also sitting at that table taking you seriously. So I think sometimes dial back and say, well, if this isn't going to work for me because I don't have a board, I don't have governance, I'm not able to hire the top 4 companies that handle audit, what can I do? What is my immediate area of influence that I could use to my advantage? You'll be shocked at what you can do when you go through that complementary, the complementary cards you have somewhere on your desk, in your room, in your pocket, in your briefcase. Form a mailing list and keep knocking and knocking. It might be the 5th door open, it might be the 100th door. You only need to succeed that once. And suddenly business takes off. We mentioned on this panel that real estate is a long, we mentioned that real estate is a long-term business. So long as, again, your intentions, your strategy is to be in real estate, success is there. What shouldn't be is that I put a big billboard and in 6 months I'm going to cash out, in which case this is the very wrong profession for you to try and do. Because there's nothing to back up it. Real estate is like farming. The house is either there or it's not. The cassava is either there or it's not. You can't kind of hide from it. That's the only kind of, I think, added that I would say. It's not a formal advice or formal route of raising funding, but I think it's one that not just for real estate, any business actually, when it comes to capital raise, it can be adopted. Good luck.
Thank you very much, Segiwa. Yes, that's, I love the spin of while you're still getting yourself ready to be able to approach the corporates and be, these are options you can explore. I love that. And I will just add, not that I'm trying to sell anything, but I will just add that in doing this, we cannot underestimate having proper agreements in place and having some proper just so that we keep that in mind, even in getting money from relatives, knocking on doors. This is an essential part. So I'll come to you now, Tola.
I think there's not a lot to add to that. I mean, Sadia and Nolas have covered it. When you asked the question, the two things that came to my mind was relationships, and that's been captured in all the discourse. I think the last bit, which is also being captured, is corporate governance, which speaks to structure. It speaks to what you shared in terms of even for family and friends, signing something, be it a 2-pager or whatever it is, speaks to corporate governance. So I think with those two things, your relationship starts from this place. There are going to be several, and there are several types of this for us. I mean, only in the last month, this is my fourth speaking. So I wonder what time I have to make money, which is what I'm paid to do, but it's part of it. So relationships and ensuring proper corporate governance.
Thank you. Erefemi, I think I'll just let you, I'll just let it slide because I think everybody, unless you have something you
Well,
want to add.
I just wanted to say that the other critical factor I would want also to put to mind is your personal values, your person. Character is key. 3 C's of credit. You talk about collateral, character is one of them. So as you are building either in the corporate and formal way or informal way, character must be there. You must be that person that people can say is credible. Transparency, we've spoken about corporate governance, we've spoken about accountability and transparency, but believe me, it stems from who you are as a person. When you're not there in the room, can urban shelters say, oh, there's some guy that we've spoken with and we've worked with once in a while and we think is credible, it can quickly help you do this. Because remember, construction itself is not the only thing in real estate. There are other, aspects of it. We have subcontractors, we have the traders that are delivering, the inputs to construction. In the value chain, character is very important. And I think we need to put that to mind.
Thank you, Enrico. Thank you very much. Speaking of character, speaking of transparency, speaking of integrity, I think I would I will go to the developers first. With the insistent building collapse that we constantly have, how would you say this has affected the market? I know that I would speak to the financiers and how it affects you and your ability to give financing to real estate development. Are developers compromising on quality? Is it because of financing? Why do we seem to be having this, or is it lack of policy? Why do we seem to be having this incidents and it seems to be rising? Yes,
Thank you. First of all, my heart prayers go out to anybody affected by this. And I think for all of us in the real estate chain, it feels deeply difficult and personal, actually. It's something we monitor as soon as it happens, sadly. And it is, quite frequent, unfortunately, because even a single one is too much. You're kind of watching the news, reading the papers, following the online to see what's happening. And it's a shock. Firstly, it's not the financier's responsibility. If anything, they help strengthen the kind of, in a good way, hurdles that developers have to go through to ensure that their development process is solid. both of you discussed, I believe, professionals, the importance of having people that know how to build, how to construct, quality assurance, getting the right stamps, getting the right engineers, civil, mechanical, electrical, getting the right estate surveyors, project managers, and so on and so forth. And then putting lives ahead of profits is incredibly important. Putting people ahead of profits. Now, and I'm going to be a little crude. I'm selfish about Urban Shelter. It would be ridiculous to go and cut corners and a building collapses because that is the end of the company. It is ridiculous for anybody to think I am going to cut corners. This building will collapse day 1, day 100, day 1. That is the end of your livelihood and business. That is even just the best case. The worst case, of course, is that people are actually losing their lives. And therefore you are criminally, morally responsible. And it's terrible. But when this happens, sadly, we need to look at the whole chain because not just the developer is responsible who may have kickstarted that process, but every point, some official will come and approve for you to continue. We have to hold ourselves accountable. It tells me that the rot doesn't stop at one person's desk. It actually is a whole plethora of agencies, of private sector, not just individuals and companies that are part of this rot that we're seeing. And really, as clients, you need to be very choosy where you put your money in. I really, really want to say this again. Be very, very choosy where you put your money. You've earned it. It means a lot to you. Be choosy. As much as the beautiful billboards look, please check for history. Look for track record. You have a right to ask for things like approvals. You have a right to ask for integrity tests. You have a right to ask for who are the engineers on this, who are the surveyors on this. If they're not willing to do that, please be choosy, take your money and move. We need you more than you need us. You need to know that you are an empowered buyer. You have options. You know how there used to be just British Airways used to come in and out of Nigeria? And then which airline joined? And then they started saying, thank you very much for flying with BA. We now know you have a choice. You have a choice, buyers, in case you don't know. Please be empowered and use it as a tool you should use. As part of Urban Shelter, what we do is something we're really sacrosanct about because, like I said, it's important for us for you to enjoy the buying process, for you to get your brothers, sisters, family, and so on, and come and buy from us. And therefore, we're only as good as the project that we're doing or as good as the last project we've done. We have a whole team that all they handle is called quality monitoring control. They all go all across our 4 states that we're in, Niger State, Lagos, Kaduna, and Abuja, and all they're doing is checking quality, integrity, and so on and so forth. Units that handle research and development as well is something we just started 2 years ago. Once we realized this is happening a lot, we've discussed relationships, more to do. I mean, we've been forming relationships on finance, but we've been forging more relationships on regulatory authorities that handle this kind of thing. It's sensitive, it's touchy. You cannot go into a regulatory office and say, you're not doing your job. I'm whispering this, please cut this out of any recording. And some situations you get people, agencies that are really trying to say, how do we do better? And that gives me great hope. You know, I think to myself, I'm an eternal optimist, and therefore I want to believe that we are learning from the past. I want to believe that there will be better accountability. And when there's accountability, you know that when you're at fault for something, you will have to be responsible and take account for it. You won't repeat it again. It's like raising a child. You know, you have to be disciplined. Thank you.
Thank you very much. Okay, Erefemi, do you have any contribution?
Okay, so I think for me, it's largely around not just, she hit the nail on the head, the value for life,
Yes.
right? And value for life starts from even you as a person. How do you even treat the next human being? Because if you actually do think about the value of that life, of that particular life, you will want to use substandard goods. You will not want to cut, even if a regulatory officer is trying to cut corners, because it's not part of your value system, you would not want to do it, right? And she mentioned something, she talked about engineers. So I think a lot of times also as a layman, not financing or investment banker, we put so much pressure on the developers, forgetting that there are other people working with these developers that if they don't pull their weight, or if something is broken in that value chain, it would eventually affect the total structure, including financing, to pay back, or people. I mean, I've seen properties in places that when you possibly pass by, you wonder, who built this? Because it's not even up to 3 years and everything has a crack and whatever all over it. And I don't think as a person or as an investor, if they tell me XYZ built that property 5 years ago and is looking all messed up, and all of that, and he has another project I want to invest, right? So the point I'm making is that's placing value on life, on people, on what we do to be able to enhance our credibility, to enhance accountability and transparency, doesn't just sit with regulators or the developers, is everybody. A portion of it that Tola touched on it a bit while he was presenting and while he was speaking on the panel also, is around how do we as financiers or investment banks or provider of funds also help this whole thing we are talking about. So somebody comes to you to raise capital or is trying to solve a problem. It's part of your ethics or your duty. It might not really, it's just morals for you to put that person in the proper perspective, give guidance. It might not be part of your work. They might not be paying you for it, but sometimes you just help them channel appropriately on what to do, how to position, the right things to put in place to ensure that project is successful. So around collapse and everything that is happening in the industry, he mentioned how somebody defaulted and then affected is. We need to look at it from the perspective that whatever I am doing as a developer or as a company could affect the next party coming, in my stead, right? Or in that pathway.
Well
Thank you.
said. Thank you very much, Femi. Thank you. I've been enjoying this session. I've just been told that we spent an hour. It doesn't feel like we spent an hour. See, with the panel here, we seem to be having a good time, but we've apparently spent over an hour and we should be going to the question and answer session. But is there anything you would really like to add to?
I think the reality is that the space is technical and accidents can happen. So someone asked what we'll do from a finance point of view. So you're quite right that financing, you don't want to take risks. So there'll be a bit more due diligence in terms of evaluating, the sponsors, the team and whatnot. But the reality is that accidents do happen in projects. What is bad is that there's a total collapse. But we've had an experience in one of the projects that we showed you there, where during the construction, maybe a certain slab failed, and there was actually even loss of life. But it goes to integrity, the health and safety standards that it wasn't worse. So it's important that I think we need, the point I'm trying to make is that we need to know that accidents do happen, but how you structure the project in terms of the parties, the health and safety standards, quality control, so that even if, the unforeseen happens, you're able to mitigate it, you can resolve it. There's the insurance policies and whatnot that would recover some of the funding. And you can still have a successful project, but accidents happen.
No, let me just add something. Okay, for me, I looked at all of the collapse that happened between last year and this year, and then I think that everyone seemed to be doing. Okay, let me put it this way. So if you're a developer, for me, I think being a developer, real estate developer, is more finance than construction itself. And then I would think that if you're a developer and then you're trying to do a 10-story, 15-story building, you should bring in a CAPA or an LLN, and then that's those are construction companies. Those are not developers. You're a developer. You're trying. Your job is to put all of the stakeholders that would together to make the projects possible. And then, when developers then go ahead, start building 22-story, 21-story, 10-story building, then I think that there's something wrong with that. And then, the cost of doing it right and not doing it right is actually not very big like that. At least it's not worth one human life. That's what I know of. So I think this is one of the things that maybe the government they need to come in and then enforce that. Not especially when you're building something more than 5 stories, you should then outsource to contractors. And this is the reason why the construction companies are taking over the industry from developers, because people wouldn't believe them, or people would want to buy something from an LLN than just from, because they think that these are construction companies with finance, with access to finance that can do or have track record of doing quality projects. So I think we should just distinguish what we're known for as a developer, put everybody together, the banks, the contractor, the construction company, and all of the marketers, everybody, and get the product done while the construction company should do their own job.
Thank you very much, Mr. Nola. I like the contribution and the approach of talking about the construction companies, and we in the real estate. I just want to add that players in the real estate sector we should take that into consideration, that the construction companies are coming into the sector and taking over what the real estate developers should be doing. And this is part of the reason is also credibility issues, the building collapse and all that. I think it's one of the take homes I'm taking away today. And knowing that we have a part to play in, should I say, redoing our image and in terms of the quality of work that or projects that we deliver in the real estate sector. Now we're going to go to the question and answer session. Please, if you have any questions and if you want a particular, specific panelist to answer your question, kindly signify. My colleague Ifeanyi would bring the microphone around to you and we'll take your questions.
Okay, sir, please state your name, where you work, and then go ahead to ask your question.
Okay, thank you. Thank you, moderator. I'm also tempted to, once a chairman, always a chairman. I'm chairman of MBA section on business law. My due respect, sir. My name is Dennis Akagba. I belong to MBA section on business law. First of all, I want to thank the organizers of this program and the ICT unit of state solicitors. For the past couple of days, they've been reminding me to come and so on and so forth. Initially, I said, look, it's wonderful. But incidentally, I worked in Texaco Nigeria PLC, multinational company downstream. There's what they call completed staff work. You know, they're doing an assignment, must perform it to conclusion. Maybe that's what the ICT people are doing. So yesterday night, there was so much rain. This people sent me a reminder again. I was tempted to reply, if there's rain, I won't come. But thank God, I live in the Kejaxis, my office in Lagos, TBS. It took me less than 1 hour to get to my office. By 1:45, I was here. I was here in this venue. And I'm happy, the weather was very good. But on a very sober note, on Monday, June 5, I was at the MBA meeting in the law school. So on the sideline, a colleague said, look, why is it that MBA is no longer vocal in what is going on in the economy and in the country generally? I said, well, it was not official, it was just on the sideline. So we said, well, as time goes on, maybe because we are in a new regime, let's watch out how things will be. But on my own, sir, when I say sir, I'm starting to chat. Why is it that we are not having MBA making some interventions? Like, carry your newspaper one day, interest rate has gone to 20%, 30%, 100%. Meanwhile, people that are making contracts to develop the house for you or do this, they must have based their calculation on a certain percentage of interest. You suddenly wake up and interest rates has gone up. And that is why most of foreign investors, I was in the multinational oil company, of course, American, British, Caribbean people, they were there. Nigeria is a country where nothing works. Why is it that nothing works? Because you cannot predict, cannot even plan for tomorrow. So briefly, sir, my appeal is we should just be more vocal. MBA, general body, and the MBA section of business law. Maybe occasionally we put on some intervention so that the government will know that, okay, we are one of the foremost civil society organizations, and the public look forward to us.
Thank you very much, sir. Thank you, sir. Yes, I think we, the lawyers in here, will take that into consideration. Who else has a question? I know there was a lady. Yes, she has. a question.
Good afternoon, everybody. My name is Francisca Aja. I represent Exum Moselle Limited. We are developers. Okay, my question and the primary reason why I came to this program is the financing for real estate. And we have tried severally in approaching banks. Even we've got their directors, and we couldn't get funding. And we're not talking about mushroom banks, but I'm not going to mention their name. So, and I was in those meetings. So now my question, and I've listened, I took time to listen to all the speakers. They actually said part of the things I would have said, so I won't go that way. So I want you, sir, from Stanbic, to please tell me the magic that you want to perform, because this is a serious issue. Our project is a very big one. And we have done using off-takers' money, raising money by ourselves, going to our cousins and aunties and uncles, digging into our savings. We've used everything. Now we have come to you, Stanbic, to please tell us what's the way forward, because we really need financing. Thank you.
We should catch up separately. That's what we should do. But I think, yeah, you know, like we said, and I don't know the basis of the project and what you approach financiers for. So Stanbic isn't special. We are extra conservative. I can tell you that. But once we key into a relationship, we understand you. I think she mentioned character. We mentioned relationship. Someone said, you know, another actually said so that, oh, you take money or you get money from banks through people you know. It's relationships, and some of those relationships start early, where the person understands your business. It's what you understand that you can sell. We are salesmen. That's what my job is, and also to structure deals. So one needs to understand your company. You need to pass the character test. Then it also goes to, okay, what's the structure? You know, so I don't know what the project, whether it's a residential one, you have to face it. You know, we've talked about, you know, creating a mortgage solution. We talked about maybe getting a cooperative to do it in bite sizes. You said it's a big project, so you start first as maybe 50, rather than, you know. So it's those things. You know, so we can sit out separately. Let's understand what it is. There's no magic one. We won't support everyone, but we are keen on the space, and we're looking to accelerate it, to grow it, and to support clients that we can work with, because it's a marriage of both ourselves and yourselves. Hope that helps. And so we can catch up separately.
Mr. Tolai say you should clap.
I have another question.
Yes, oh, okay.
Okay, good afternoon, everyone. Thank you very much. My name is Olaomi Olatunji. I work at Brockville Investments Advisory, and we cover the energy and natural resources sector. So we provide financial advisory services, and includes real estate. I just want to make a comment, and also perhaps Erefemi will be able to allude to what I'm saying. right? I think a lot of challenges that the project developers face, cuts across all the sectors that we work in, is the fact that they do not put together a compelling message, which is that projects are not really bankable. So putting together, you just said earlier that, you need to be able to convince the people that you're trying to talk to. So that's one thing. But beyond that, what I really wanted to talk about was the fact that we need to look at more innovative means of financing. So in the energy space, especially the renewable energy, so we talk a lot about energy efficiency. So if you think about energy efficiency in the dimension of project development as real estate, so you can actually bring that mindset, that thought, and think of green bonds. So the World Bank has developed a structure. There's a framework for assessing your projects to see if your projects can fall under the category of green bonds. And that's why I think Erefe may be able to talk about, or any other person, where you will think beyond, just trying to have a very good capital structure and say, can my project become, can I look for green bonds, which will fall under this IFC World Bank kind of structure? And I think it's another way where we can think of sources of financing. Thank you.
Okay, thank you. So I think you're absolutely correct. There are other means or other ways you could raise capital. And if I tag it to a question, I think it starts from what you're trying to do. While she was speaking, Sadatu just said, what kind of structure? If you want to go into a project, you would have done your cost analysis, I believe, and you will know what it would take, at least reasonably, from start to finish, right? And then you segment the capital sources accordingly. So you mentioned off-takers, you mentioned family and friends. She just mentioned other channels that, you can also access funds from. So outside your typical collateral character and all of that, I want to believe that the projects that you are talking about, if you have used some level of funding, would have gotten to a particular level, wherein you can then use that as security to access funds, right? And outside you using it as security to access funds, you are also going to look at it from the perspective of, we mentioned track record. If you're a new developer in the market, a year to 2 years, you might not be able to get cheaper funds. I'll be realistic. And you might not be able to get it from the likes of Stanbic. And I'm being serious. Stanbic, he mentioned relationship. Maybe via relationship, they know you, they've seen what you've done in the past. They might be able to, help, but you might not be able to come to the market. And I'm being very serious here, like Urban Shelter, to come and access funding. So you might still need to use some other sources, like she mentioned, to be able to finance your project to a reasonable level, wherein someone else can then, help you impute. And we talked about it, professional parties. So I wanted to mention when we're speaking, a lot of us, sometimes including myself in my personal space, we like to do things from start to finish by ourselves, not seeking for help. Seeking for help starts from the professional parties you use around your transaction that would have been able to guide you accordingly on how to go about things. Solicitors, financial advisors, trustee, whatever it is, will be able to tell you at what point in time or what you need to do correctly. And those other sources that she mentioned, but the truth also is IFC BOI will not just jump on a startup kind of projects, So you really need to speak to consultants. Don't try to do it yourself. You need to talk to people that can help you to structure appropriately so that accessing fundings won't then be the issue. But she's absolutely right. There are other measures, other means around raising capital.
Good afternoon, everyone. My name is Abubakar Sharif. I'm the Managing Director of VAVA Projects. I would like to, first of all, talk about the issue of substandard work in the real estate. And in actual fact, I would like to look at it from the angle of how do you want a developer to survive if the first thing is faced is to engage a contractor who is going to demand for about 30% upfront payment, and who everybody believes can do a quality job. Or rather, why shouldn't the developer establish a construction department, put in the right professionals, and ensure that those people are working with no control or interference from the so-called developer who is not an expert in the building industry. So we have to look at these two things together. Are we saying we shouldn't develop our local capacity? Are we saying we shouldn't develop companies in Nigeria that can compete with LLM ITB? So if we are running a real estate firm, and you have to realize that, number one, the money are coming in trickles. Even if you have a seed money to invest into a real estate project. For example, if you have a project of about 2 billion naira, and the seed money you are able to get is about, say, 500 million naira to start the project. And afterwards, what you are relying upon is the payment from the off-takers. Because for us in our company, the issue of going to the bank for loan is becoming a no-no. If you are taking about 500 million now, by the time they add all the other charges to the interest, it will be about 30%. That is about 150 million out of the 500. The money is gone. So we really need to look at most of these things holistically. We are not developing local capacity in construction. And the reason why we are not developing that is because we refuse to mechanize our operations. Although mechanizing an operation is all about funding. The only reason why we are looking at all this ITB and LLM is because by the time you see their setup, what you see is crane on site, they have their bashing plant, they use their premix. The whole site has equipment, and the manual inputs will be very, very less. So the precision of their construction will be very, very high, even when you are looking at their formwork. So even as Nigerians, are we competing technically? Are we trying to build our capacity in this regard? My answer is we are not doing enough. We are not investing in equipment. A typical Nigerian developer, I'm very sorry, would prefer to go and buy a G-Wagon of 150 million naira. As a construction person, I can tell you today that 150 million naira can get you a lot of equipment. That when you put it on your site, even your prospects that are coming to buy from you will be attracted to your projects. Because with those kind of equipment, you are sure of the quality of what you are turning out. So we have to increase capacity. We need to increase capacity a lot in the building industry. As Nigerians, the foreigners are dominating us to the extreme. And you see a lot of Nigerians, even our own mentality, if they don't see Oyibo on site, some people will not even buy from you. Whereas we are turning out a lot of engineers on a yearly basis. Are we training them enough? Is government helping us even to increase the capacity? So that is number one area I would like all of us to look at and see the way Nigerians can compete with these foreigners. We are doing it in other sectors. Why not construction? So that's number one. Then number two, the banking industry, for me, is not an area a developer should be looking at. Because if I look at the margin you make in a development, I don't think there's any real estate developer that makes between up to 25 to 30%. And you have to, on some projects, you have to spend like 3 years. So how can you now go to a bank that is going to charge you between 25 to 30%? That's ridiculous. And that is why you see a lot of abandoned projects and substandard projects. By the time they start, before they get to half of the project, the whole money is gone. So we will like the government to come to the aid of real estate.
Yeah.
So that we can have a single digit interest rates.
Thank you very much, sir. So allow me, we have a couple, okay. Okay, your response, yes.
Yeah, so I think, we're all in this room, and it's important we don't leave here with the wrong message. And it would be a discredit to what, the initial presentation, which I shared and which was shared, and then the panel discussions. It's all about structures. Nigeria is not more special than anywhere else in the world. And capital, there's no one, that's the message we said here. So let's go on with that. Capital takes different forms: equity, debt. Debt itself has different forms. We've talked about bonds, we've talked about green bonds. So capital formation is in different ways. So why is there then mortgages to enable people buy homes? So let's don't leave here with the wrong message. You need an advisor. So the same way you need legal advisor when you're going into loan documentation to take capital, you need an advisor. So you do not take the wrong debt. I remember I said positive leverage. So let's understand that. So that's important. And the same, the kind of leverage differs for different asset classes. Loans for residential is different from a commercial office. Please, let's leave there with that. This presentation will be shared. If you have questions, I mean, people call me randomly. I'm happy to share those thoughts. I'm just going to the banking side, to the loan side.
Thank you. Okay, for the lady asked the question there. First, I was going to say something to that, but I couldn't. Since there's not a lot of time, I would like her to see me after this, because I feel like I've been in ashes before, and then I just need to be able to sit down with her so we can just see me, yeah. And then to my brother, the Viva Construction, if I'm correct, Vava, all right. So I think that what I was saying when I was talking about construction companies, take for example a Black Diamond. You said there's no indigenous construction. There is Dotum, there is Black Diamond that I know of doing fantastic projects. Black Diamond has delivered some of the best projects in Lagos. What I'm saying is you would grow more as a developer if you contract out your construction, a lot of your construction, to contractors than when you do it. Look at her, she's doing 17 projects simultaneously across Nigeria. Do you know the amount of time, amount of energy, amount of project management, amount of monitoring, amount of all of those that would require if she was executing and building herself? How would she then be able to network someone like Tola when she wants to go to the market to raise funds? How is she able to meet do all of those, the capital to raise money? I think that if you are not raising the right money for your project, it's because you are going directly facing the construction of your project yourself. I would think that you would grow more quicker if you contract out that. Look, I think it's only in construction and this part of the world that you do brand building, you do marketing, you do finance yourself, you do the actual operational work. In every other industry is contracted out. You just need your quality control people to monitor the actual product that you're selling. And then what you should concentrate on is marketing, raising money, and brand building, and a lot of other little things. And this is the reason why you grow quicker. And then talking about the Oyinbo people on site and people being happy. To be honest, I don't know that. I've never used any, but yeah, I mean, people, it's perception. and then, people are drawn by with what they see. And then if the perception is when they see Oyinbo people on site, you can hire a project manager that is Oyinbo and put him on site, And then lastly, saying that there's no construction company that is doing well, I think that's not that's not true. And Etola said that you need to know the kind of leverage to pull in a project. Say, for example, I want to do a residential project. I've said it before that I do not think that you should stay so long on the bank debt for residential, especially if it's going to be more than a year. So we initially designed the project for apartments, right? So we took the money and it came at 25. And then I saw that, look, if we start building apartment, we'll stay on that project for more than a year. And what we then we did is we converted everything to terrace building, such that we can, finish the carcass in 4 months, sell and end everything about the project 9 months to 12 months. And then we can still be profitable, pay back the bank money if we are not able to refinance at a cheaper interest within that time. And this is the work of your CFO. And then, but if you concentrate on building and you keep going to site, you might not be able to sit down and look at this structure and do it. And then, yeah, so I hope I'm able to say something.
Thank you very much, Mr. Dola. Now we'll take a few questions from our online, from people on Zoom, just a couple of questions and around.
Okay, so we have a question from Ayobami Akindipe. We will be projecting the question. Okay, I'll just go ahead to read it. So Ayobami says, when we realize these problems and difficulties we face with policies, I believe this question is a spin-off from the conversation around policies. So he says, government agencies and even financial institutions' policies, what exactly is the solution? Writing to the government or what? Or do we just find our way around these problems continually? It's not directed to anybody particularly.
So my second job is, I don't know if you know Nigerian Economic Summit Group. I'm a facilitator for the Infrastructure Policy Commission. They have 6 thematic groups. One of them is housing and urban development. So it's an advocacy group, by the way. It's a private sector-led advocacy group that interfaces with the public on a number of concerns and issues. And one of them is things like this: policies, regulations, bottlenecks. And it's across, and it's across all industries, but I'll speak to the housing one because that's part of the commission that I cover. So we've been advocating for the last couple of years in terms of a number of things, which is a 131 policy, which is 3 days to process handover of documentation, in particular processing of certificates, one-stop desk, and 1% fee, as opposed to what it is now. It can range depending on the value, depending on where you are in the country as well. And I think some of the steps at the last count was something like 26, 27 steps just to transfer title from you to I. So obviously, so that breaks down in terms of the time. It isn't an easy process. It does sometimes feel like you're swimming against the current, but it has to start with somebody. It starts to start with an organization and you continue to push. But that is just one company, Nigeria Economic Summit, and they're trying to do a whole lot, not just on housing, but generally looking at how to aggregate the number of issues that surround bottlenecks in policies, in regulations, in act, in passing certain bills as well, and so on and so forth. Yeah.
Okay, so the last and final question from Prudence Ajiru Ogene. So Prudence says, the panel talks about proper corporate governance. What are the specific things that financial institutions look out for when structuring a loan facility for real estate companies or developers? Okay, what are the specific things that financial institutions look out for when structuring a loan facility for real estate companies or developers?
I think we already answered it, but I will let Tola just rehash or highlight some of the things here earlier said.
Yeah, thank you. I think you're right. We've already touched on that, but I think just to closing thoughts on that portion, it's the sponsor. So we've talked about character, the track record, integrity, which speaks to character as well, but it's the sponsor. So we also talked about ensuring that even when you start small, you have financials, you have the right legal structure. You have audited accounts. You can start with maybe not the big four, but anyone, but at least just show that so that your history is seen. So that's on the sponsor side. The other part which I mentioned was on the asset characteristic. Where's the location? What type of product? What's the pricing? Because I mean, if you think about it, if you say you want to buy a house, and I think one thing that given the market study, it's overpriced, even though you are speccing it for that price. The reality is that if it's overpriced, that creates an affordability issue. You might sell, but you might not sell as quickly, and that begins to distort your economics. And if you can sell within the time that is provided, then the product begins to fail. So it's those kind of elements, the asset characteristic, and ensuring it is bespoke and structured for that funding or that investment. And then the last is, which ties to the initial two, is the cash flow sustainability. Two factors: build to sell, ensuring that you can sell within space, and if it's built to let, ensuring that there is long-term sustainability in the product.
Thank you very much. Please, we would like to apologize to both our physical and virtual participants for not being able to take all the questions, but please feel free to always reach out to us if you have any further questions for us. Thank you very much.
Thank you. Thank you. Thank you, Ifemi. Thank you to my panelists. It's been an interesting session. Thank you for coming. I think now we would take photos and we'll be done. Thank you once again.
Thank you. So, good afternoon, everyone. So just to get everyone's attention, so particularly for our speakers. Sorry. Okay, so please would like to have a quick presentation. Sorry, Mr. Noah. Sorry, Mrs. Adigu, please would like to have a quick presentation. Please have your seats. So if you can allow me to help present the gifts, please. So just to get everyone's attention. Okay, so please, thank you very much, Mrs. Sadiya Ali Aminu. We're grateful. Thank you for coming to spend this day with us and sharing your knowledge. Thank you so much. Thank you so much, ma. So, and also Ms. Akeredolu, we would like to share these gifts with you. Thank you for your time. Thank you for coming to spend the day with us and share from your wealth of experience and knowledge. Thank you so much. And to Mr. Nola, thank you, sir, for your time. Thank you, Mr. Nola. And finally, to Tola, thank you for taking time to answer the numerous questions. Please, can we clap again for our speakers as they go back to their seats? Thank you very much for your time. Okay, thank you, everyone. So please sit down for the next 2 minutes. So on behalf of Detail, I would like to say a big thank you to everyone for coming, for taking the time out to drive down to Lekki and sharing your day with us. We hope you've been able to learn from today's session, and we hope that you would always reach out to us if you have any inquiries. Thank you very much. And just for the last note, please, we have snacks. It's on the room on my right. So please feel free to take a snack and share a drink while you network. Thank you very much. Enjoy the rest of your day. No, don't worry. Most of the time it's always like that. Because once they start before the session, no, as in that position should have been after. Just do your thing. Forget, no, but I think you can maybe go around and get the thing to keep moving. You can just direct you to the right thing.
Some refreshment prepared for you. Okay. Freshman Johnny. Freshman Johnny. Also.